All right. Good evening, everybody. Thanks for joining us this evening for our weekly market update. And my name is Robert Cruz, one of the principals at the Lutz & Cruz Group here at Keller Williams in Cupertino. And as always, as we do each week, we do a quick update on what has transpired in our markets in the last 7 days or so. And we try to take a very different approach than your typical real estate team. That doesn't mean we don't do what everybody else does. We do, in terms of if you're looking to buy properties, how we help you search, how we identify properties. If you're selling a home, how we advise you on how best to prepare and get maximum return on your listing. We don't talk about those things in this meeting. We talk about what we do that is quite different from everybody else. And we try to explain some of our thinking around that, how we help buyers and sellers identify current market conditions, what has led us to this point, what are we expecting in the coming days and weeks or months, depending on your timeline. And it's pretty unique, but it's not new. It's something that I've been doing for over a decade in various roles in leadership in Silicon Valley real estate. I'm well known for anticipating what the market is doing, coaching and training agents, hundreds of agents, thousands of agents over the year, how to go directly to buyers and sellers and answer those questions. And we just thought that the way information moves today, the access to information that buyers and sellers have, we want to get it directly to you. So if an agent invited you, thank you for showing up. Thank you for coming. Any questions that you have during the presentation, you can type in and we'll try to answer them in real time if we can. If we can't, we'll definitely follow up with you and answer those questions that might come up. And as always, any need you might have around buying or selling real estate, if you simply just ask questions or do a deeper analysis using the methodology that we'll talk about today to identify your wants and needs and prescribe actions that you might want to take now or in the very near future to maximize return or savings, depending on whether you're a buyer or a seller. So with that, we'll start in. Hopefully, I want to take about 20, 30 minutes to go over what we like to discuss in these market updates, leave time for question and answers for you and the real estate professional that invited you. So let's jump right in. Each week, I like to take a headline from a national source that kind of sets the tone for what's being talked about out there. Because the reality is, most people are not talking directly to a realtor about what's shaping the market, what are the different factors going in and out. They'll talk to us about, can I see this house? What do you think about my home? Questions like that. And as I said, we do all of that, but what we do here is quite different, and it starts like this, right? So this is a great article from CNBC, just released on Monday. And I love the headline. In this volatile housing market, here's how to know when the bottom is in, right? So a couple big points there. The volatile housing market. It is volatile, and it changes weekly, not monthly or yearly. Of course, that does that too. But weekly, things move so fast that if you know a realtor, give them a hug. They need it, right? For all of the end of 2022, we were struggling. There was no activity in the market, or very little activity, a lot of doom and gloom. We wake up January and we're off to the races. And that can change overnight. So it's true for real estate professionals. It's true for buyers and sellers in this market. So I just synthesized some of the key points that come from this article. Here's spoiler alert. They don't tell you when the bottom is in. Right? So I didn't include that. But that's kind of the point. You never really know. And this is a national article. Even if they knew, every area is different. Every want and need is different for individual buyers and sellers. But I thought the key points that they came up with were really important. They start with forecasts for home price declines this year are moderating. Zillow now expects a slight increase. Now, 3, 4, 5 weeks ago, all those headlines around what should we expect this year, almost everyone was talking about declines. 10%, 8%, 9% declines in home values this year. In 3 or 4 short weeks, some are now saying not only will it not decline, it will grow. Zillow is one of them. Mind you, the majority of prognosticators are still expecting some decline in home values overall this year. But it's important to note, at least one major one saying here, we're going to grow this year. That's a dramatic departure from just a few weeks ago, right? Next thing, inventories are climbing, but below pre-COVID levels, and existing home sales are stabilizing, right? So when I read that, it starts with a headline of volatility, and the second bullet point is talking about stabilization. How are those two things working together, right? Well, the key word is it is volatile. It has been moving. That's past tense. Stabilizing is talking about the future. What should we expect? That's where should it stabilize? Higher, lower, or where we are right now? Incredibly important answers for you depending on what you're thinking of doing in buying or selling. Third one, biggest housing market declines have occurred in cities that soared in 2021. That's us. That's us. That's Silicon Valley. That's Austin. That's Phoenix. That's some of these areas that absolutely boomed during COVID and a year or so right after it. Now, having been in the real estate market here in Silicon Valley for the last 20 plus years, I know one thing. We have the biggest gains and we have the biggest drops. That makes sense, doesn't it? Right? So always take the long-term view. We are experiencing in some places in our valley some drops in value from the peak being around May of June of last year, but it's dwarfed by the gains that were made in the same places in the previous 2 years. So you're comparing 30-40% gains from 2020 to the peak last June, and maybe a 5-10% drop overall. That's a massive gain, right? If you bought in June of last year, and if you were selling just 9 months later, that would be an issue, obviously. But that's actually very rare. And anyone that would be selling just 9 months after purchasing, usually there's been some dramatic event in their life that has them and forces them to sell. The reality is the bulk of consumers that are thinking of selling, they're coming to the end of cycle in a more traditional sense. They're empty nesters or they're move-up buyers, need a bigger house. They're retiring. They got a huge job wage increase. And for those people, you're talking about longer terms. So these last 6 or 7 months of price volatility is less important. That doesn't take away from the fact that they may have missed the peak of the sales, but we'll talk a little bit more about that in a second. Final thing, unlike 2008, a lot of talk in real estate about 2008. People have more savings and jobs and less onerous mortgage loans, with 85% of homeowners under a 5% rate. We're going to talk a lot about inventory today in the next few minutes, and this is key. Most people that are expecting, hoping, I don't know, dreaming of a massive collapse, right? The doomsday scenarios. The thing required for that is inventory to increase to those 2008 levels. The reasons for it are not as important as the actual levels. To get 20, 30, 40% decline in values, we would have to reach those levels of inventory and maintain or weaken the pool of buyers. Until someone explains to me how we're going to grow from barely over a few hundred listings to a few thousand, I don't buy into those theories of massive price drops and collapse. So really important points there. They further talk about no bust, but a standoff between buyers and sellers. Instead of a price bust all the one after the 2000s housing bubble, what's developing is a standoff, says Logan Mohtashami, lead analyst for Housing Wire in Irvine, California. He describes, on the one hand, are buyers who would like homes to be as affordable as in 2019, before we had this latest massive rise in valuations. But a big share of them either have to move or can afford to despite higher prices and rates. On the other side are sellers under no pressure to move, since they have cheap mortgages and plenty of equity for now. So if they don't get the price they want in the open market, they just hold it. I mean, think about it. What's their recent relationship with holding real estate? It's been really good. They've been really rewarded for owning and holding real estate in Silicon Valley. Growth by $200,000, $300,000, $400,000 in valuation. it's kind of hard to pry that person away from an instrument that has shown them so much gain. And while most people don't think about that, they do know they have a buffer. They can afford to risk, is there another 5% upside? If they lose 5%, they're still up 30, 40, 45%. It's important to understand, if you're a buyer, that mentality of the seller, right? So I love this, that they point out this standoff between buyers and sellers. Here's why I like it as a real estate professional. Our talents and our skills are most pronounced and most valuable to you as a consumer when there is that standoff. When it's only going up, it's like, well, just pay them whatever they want. That's how you're going to win. When it's crashing, they're like, give them the lowest offer you can. They'll be forced to take one eventually. Our skills don't come into play as much in those situations. I've lived through both. I lived through like, hey, that's all you're going to get. You might as well take it. You haven't paid your mortgage for 9, 10, 12 months anyway. You're going to get foreclosed if you don't accept that offer. That doesn't take a lot of negotiation skill on my part, does it? On the other hand, for 2020, you want to buy that house? Offer them all the things that they want, because there's 10 other people that will offer them more than you. Again, not a lot of negotiation or skill on my part. Now it's like, hey, they don't have to sell it to you. And if you're a buyer, like, well, you don't have to buy it. So we've got to negotiate. We've got to really think about what are the positions of each individual on either side, what are the conditions of the market, and then how fast is it moving? How fast do you have to decide? Those are the things we want to focus on here, right? And again, when we have a more balanced market, which we do right now, with some volatility, it can go up and can go down. Rates can go up, rates can go down. What we say to a buyer on one day can change literally in 24 hours. And it did this week when rates jumped from around 6.1, 6.2, around that range, up to 6.8, right? So if on Monday we're looking and you've been quoted as a buyer 6.1% interest rate and you don't go into contract, the next day the bank is now at 6.8. That buyer's lost 7, 8, 9% buying power. Now the reality is, it's not just that buyer and that interest rate, right? The entire pool of buyers has lost that buying power. That means the sellers are in the market that did not accept an offer. Now they have to realize every buyer out there is that much weaker, meaning the likelihood of a higher and higher offer is diminished. So these are incredibly important things. And again, within 24 hours, that can change. You can have your home price listed properly on a Monday. The rate goes up on a Tuesday. Wednesday, you should really guard yourself for, I might get lower offers now. I didn't accept the one on Monday. So buyers don't think it's just you. The Fed is not like, I'm gonna hammer you. I'm gonna raise your rate. They raise rates across the board. That affects buyers and it affects sellers. Completely changes dynamics in the market. And that's what we want to focus on. That's where we want to help you understand those intricacies and know that things can change that quickly. It's why we do this update every 7 days, because things do change that fast. So they conclude, we have seen significant year-over-year decline in the housing market with fewer sales and more new home cancellations. We're just starting to see the impact on house prices. Just starting nationally, not locally. New listings are at a record low, but the year-over-year decline was smaller in January than the preceding months. Existing home sales will rebound a little in January, but will still be a low level. Housing starts will probably show further declines and still a near record number of homes under construction. I told you, they didn't tell you when it bottoms out, right? And we're not going to tell you either because we don't know. We have to analyze what's your timeline, what are your wants and needs. Within that timeline, can we match your want and your need? That's how we operate. And let me show you how to do that. We look at 3 things fundamentally when we're analyzing the market and your need as a buyer or need as a seller. And those 3 factors are speed of the market, how fast is it moving, demand and supply. Demand and supply are pretty well known to anybody, really, growing up in a capitalist economy like the United States. We all at some level understand supply and demand. And it holds true in real estate. If demand is up, pressure on prices goes up. If demand is down, pressure on prices go down, right? There's a relationship. If there's very little to no supply, then that creates almost any demand as a pressure up. That's where we are right now. It's super low inventory. The factor that I've taught, I think successfully for both agents and buyers and sellers that work with us for the last several years, is how fast is that moving? Traditionally in real estate, even today, when you look at what's going on in the market, even in the last slide, we talked about what happened in January. We're already near the end of February. But most data you read about in real estate is 1, 2, 3, 4, 5 months old. Average days on market in Silicon Valley is under 40 for the whole county. In some areas, it's as low as 20 days. So that means every 20 days or every 30 days, whatever the days on market is, that entire market has shifted. A whole new set of sellers and buyers have negotiated prices. Now, whatever price that is, the next group of sellers and buyers have to compare, use those as comparables to what should we pay next week. If they go up in 1 week, then the prices for the next will go up. If they go down 1 week, then there's pressure on the prices downward. So let's jump in there. First one, speed of the market. I start with this one because it's a newer concept. Most people aren't familiar with it. And so I want to make sure you understand it, because this is really what's driving much of what we talked about today in Silicon Valley real estate. So this chart shows the relationship between available properties, measured as month supply, how many houses are on the market. Months of supply means if we add no new houses, how long it takes to sell what's on the market, right? Anything below 1, 2, or 1 month is dramatic pressure on prices upward. That tells you demand is super high. Whatever the amount of properties for sale, there is sufficient buyer demand to soak them all up. It's what we're experiencing right now. Despite the negative headlines and the slow fourth quarter, buyers are out in force, they're flooding open houses, they're submitting and bidding against each other in multiple offers. So whatever the headlines are saying, the reality on the ground is buyers are showing tremendous appetite for these homes and these prices because there's so little inventory. So you see San Jose at the top left corner, consistently under 45 days on the market in months of supply. And you see the pressure on prices continues to stay positive, right? And as you go further to the right, it takes longer to sell. That means buyers have less pressure to see a house, like a house, write an offer that day. They can think about it. They have time. They can see what comes out in the market next week and the next week and the next week. We don't have that luxury as buyers in our market. When something really good comes out one day on one weekend, it's going to sell. And so the thought process that goes into making decisions on price, location, things like that, there's a lot of pressure on buyers to do that. And so then you get that frothy market where decisions have to be made quickly. You don't want to start your decision-making process when you see the house, right? You want to know budgets, you want to know timing, you want to know all these things before you start looking, because if that's when you start, you've done a lot of legwork, we've done a lot of explaining, we've analyzed the market, what are you looking at, what are you considering, so that when you see that property that you like, you're ready and committed to write winning offers, right? This is the speed of the market. It's a simple correlation. The lower the days, the month supply, the higher the pressure on prices upward. We're consistently in that here in Silicon Valley, right? This is looking back over the last 15 months or so, and you can see a real dramatic correlation between what we just talked about. On the bottom, you see days on market. This is for single family properties in our county. And you can see for the last quarter of 2021 and the first quarter and a half of 2022, days on market was under 2 weeks. That is extremely fast. Those are the headlines you read about 15, 20 offers per property, 100, 200, 300K over asking price. We were not talking less than 2 months of supply. We're talking less than 14 days. And so that was what resulted when that happened. You can see at the top, that's the percentage that buyers were willing to pay over what the seller was asking. 9%, 9%, 11%, 15, 16% over asking price at the peak in March of 2022. Now, you have an understanding we're a very expensive market. We're talking 16% above median prices of around $1.7 million, right? That's how hyper competitive the market is. And you can see once interest rates hit 7% around March and April, buyers step back. They're like, wait a minute, that's quite a bit to swallow at one time. And you saw the immediate decline in list to sales price ratio. We took buyers out of the market. They were not willing or able to pay those prices at those interest rates. And we saw the list to sales price ratio drop. It got it under 100% for all of the fourth quarter and even into, I'll show you in a second, in January, right? Now, mind you, this is not real prices. This doesn't mean that prices fell. That just means that typically when you see markets expanding using comparable method, which is how we price homes, what did the last one sell for? Well, we'll list it for more. And they got 10% over. What the last one sell for, we'll list it for more. The same is true in the reverse. But once buyers are not soaking up as fast, then the offers will come lower. And you'll start to get that trend of 97% under. These are averages. That still means some went for over asking price. Which ones? The ones that are turnkey, the ones that are the nicest. If you were to take out just the turnkey properties, they still went over 100% asking price, even as the doldrums of fourth quarter hit, right? That's gonna be important for you if you're chasing value in the coming weeks. So again, here you see days on market, very low, list to sales price ratio skyrockets. Days on market starts to trend up, speed of the market is slower, competition goes down. Simple numbers. The Fed wanted days on market to grow with fewer bidding wars, and that's what they achieved by increasing the cost of money and raising interest rates. You can see that nationwide, January 2023, we're at 19 days on market. January 22, we were at 19. This January, we were at 33. That's closer to 100% increase, 200% increase in days on market. That is what we're feeling. We're like, it's not as competitive. And it lulls some buyers to think, well, the prices have dropped. The rate of increase has slowed. The prices have not dropped. Okay. That's speed of the market. Again, newer concept. Most realtors don't understand it, much less buyers and sellers, but we understand it. And we teach it fundamentally because it's such an important factor in what we do. Now, here's what everybody understands: demand. What's the demand like? When interest rates were at 3% or sub 4%, I mean, the banks are begging you to buy houses. That is very cheap money. And consumers responded. Like, you will lend me millions of dollars at that interest rate? You almost can't say no. And they didn't. And buyers flocked in droves and drove valuations up. That, along with other factors in the economy, created an environment where inflation started to hit. The Fed said, we need to slow this down, so let's make the money expensive now. And we jumped from 3% close to 7%, and all of a sudden, real estate was hard. The houses were still nice. It was still beautiful weather and great place to live, but it was expensive, a lot more expensive almost overnight. Put the brakes on. So what's going to happen next, right? That's the key. We went from 7s down to just below 6%, and now we've jumped back up to 6.7 or so. So watch this. We watch it for you. That's a big factor in what's going to happen next, and let me explain why. When the market moves this fast, you cannot look at what the data did last month, the previous month, to know what's going to happen next. So we've got to use data that tells us what's going to happen next. One of the greatest ways to do that is to measure who's applying for a mortgage. So we look at mortgage application data. We know that when someone goes and applies for a mortgage, in the next 30 to 90 days, they're going to be writing offers on properties. So we watch that. If the number of people applying for mortgages grows, we know the demand will grow immediately in the next 30 to 90 days. The inverse is true also. If the number of people applying for a mortgage drops, we know the number of people offering on properties is going to decline. So we get a good read of the next 30 to 90 days on this mortgage application data. From November 9th to about a week ago, it was positive week over week. So while the news again was very negative, we knew more people were applying for mortgages. That means more people are going to be in the market to buy in December, January, and February. We were able to read that and tell our buyers, you're going to be in a very competitive market despite the headlines that are backward facing, because we look at the data that's forward facing, and we were right. Last week, it dropped 18% week over week. That's important, not for the weekly data, but now that stopped almost a 3-month trend of rising week over week. If the next couple of weeks continue to drop week over week, then we might revise our idea of like what will February, March, April look like. So far, still positive. 1 week, even though it's a big number, drop is not enough to change the current pattern. Current pattern still is more buyers in the market, more pressure on prices up. Mortgage application data tells you what buyer activity will look like 30 to 90 days in the future. When you meet with us, if you're a buyer, we'll tell you, hey, you know what? There's gonna be a lot of people competing with you over the next 90 days. When we look at supply, that's dropping. So you will be pressured to make quick decisions on very, very important things, right? What will I buy? How much will I can afford? What can I spend? Don't get priced out. We'll share that with you. If you're a seller, we'll share the same thing with you, right? If you're a seller meeting with us, I'm like, the market's really good right now, but applications are dropping. So if you're looking to sell in 90 days, you might miss this little frothy period, right? So again, depending on your individual circumstance, whether a buyer or seller, in which market, we can tell you a lot of what you should expect in the next 30 to 90 days. So here's demand in Santa Clara County. This is absorption rate based on pending sales, a forward-looking number. This is consistently telling us what's going to happen next. If the absorption rate goes up, pressure on prices goes up. And you can see it here looking backwards. Fourth quarter 21, first part of second quarter 2022, triple-digit absorption rates, massive buyer bidding wars. When it dropped into the 60s, 70s, it minimized. Mind you, anything above 33% is a seller's market. The sellers still have the upper hand here. And look at this jump. That's the reading at the end of January was 64%. As of today, it's 107% in Santa Clara County, right? That is telling you what buyers are willing to compete at, and they're competing hard. So to enter this market as a buyer right now, you have to know that, or else you start chasing the tail, meaning you're writing offers that just won't win, and the next one just won't win. Guess what? The sellers are seeing this return, and they're raising their prices in the short term. So the opportunity cost of writing offers that just barely miss is quite dramatic. In our markets, it can go up 1 or 2 or 3% in a couple of weeks. You're talking 30, 40, 50, $60,000, right? And we'll explain this in full when you sit and talk to us. And budgets are budgets, right? We understand that. But we will explain to you what the market conditions are. And then based on your budget, again, based on your wants and needs, we'll strategize on where can we find you value in this market, right? The next thing, again, we talked about days on market and list to sales price ratio. At the end of January, sellers were getting 94% of what they asked for. First 2 weeks of February, it's up to 98%. In 2 weeks, a 4% difference. That's around a $70,000 jump in the average, right? So I don't want to sound hyperbolic, but when I tell you it changes that fast week to week, that's a dramatic example. In 2 weeks, it's jumped 4%. That's tens of thousands of dollars. Again, it's an average. You don't pay the average, but you know the trend. And then understanding that trend and what you should expect for the coming weeks can save you a ton of money. Okay. On the supply side, this is going back to 1984. This is incredibly important. You can see since 2008, supply nationwide has dropped steadily, dramatically, consistently. And there's nothing on the horizon that's going to push this amount of supply higher up. So we have consistent, chronic low inventory. As long as we maintain any amount of buyer demand, prices are going to be supported at a minimum or rise, right? Again, for Santa Clara County, you can see since 2007, The bars there are how much supply has dwindled. The blue line is new listings. Those are pretty steady. What that tells you is the buyers are hyper aware of the best turnkey properties. They snatch those up first. And those that are not the prime properties, they'll last a little longer, but never to the point where we start accumulating a ton of inventory. This year started the same way. New listings, which are the prime properties that every buyer really, really wants, have actually started lower than the last 3 or 4 years. You can barely see it down here, but it's the lowest number in January when we compare the last 4 or 5 Januaries of the inventory. Locally in our market, this is Santa Clara County single family homes. You can see year over year, I think I blew it up here. Active inventory is up 59% year over year. There are more to choose from. The new ones to the market are down 35%. I cannot stress enough how important that is. The houses that come on the market that are perfect, ready to go, get swallowed up quickly. That's driving the averages higher. And so don't get seduced by, well, there's more properties to choose from. The properties that are left are the ones that the first wave buyers didn't want, right? A couple of ways to look at that. You're not getting the premier house. You're also not getting the markup of this. The previous seller did the painting. The previous seller did the upgrades. You buy it as is, there's a ton of saving there. So if you need savings as a buyer, there is a strategy and there is a methodology to find that. And that's why this number is so important. Lastly, you're going to hear consistently over this year, because it just hit, we're at the lowest level of mortgage applications in the last 30 years, right? I already set that up. That's a great indicator of what's going to happen next. You will hear the headlines, especially if you're a buyer. Mortgage applications lowest in 30 years. Look at this. Watch this trick. As a standalone headline, that's scary. If you're a homeowner, like the lowest level of buyer interest in 30 years, that's going to cave the valuation of my property. If you're a homeowner. If you're a buyer, you're like, yes, I'm going to get a deal. You're both wrong. Here's why. When you look at, I'm not a graphic expert, so I try to show this. If you look at the last 30 years, yes, we're back to like 1990 mortgage applications. But look at our inventory compared to 30 years ago. Is way lower. So understand that. You have to compare apples to apples. We have fewer buyers applying for mortgages today than 30 years ago. We have way fewer homes for sale than 30 years ago. And if you want a turnkey property, that number gets even lower. So don't get seduced by these headlines. Headlines are designed to worry you, panic you. That's how they sell. We need to have this kind of discussion so you understand you have to create strategy where you take all of these things into context and to get the real number on what you're looking at as a buyer or a seller. So I'm going to finish with something here. And I want to show you in real time. One of the premier markets here in Silicon Valley is Sunnyvale. It's always the first choice for buyers. And I don't mean that because I'm a big Sunnyvale fan or anything like that. It's just the way it is. When you think of all the factors that drive valuations in a community, Sunnyvale has all of them. Great schools, proximity to shopping, dining, jobs, to traffic and traffic corridors and things like that. So I like to start there because let me show you something. Let's see if I can figure it out. We'll finish with this. What I do here is I overlay a forward-looking number, which is the absorption rate. This is the dark line. When the absorption rate moves, the list to sales price ratio follows. So you can see here, starting December of 2021, the absorption rate in Sunnyvale started to fall. That, after a lag of 2 months, this list to sales price ratio started to fall. In the last month, you can see the absorption rate from January to February. This is current as of yesterday. is skyrocketing, moving up really, really fast. So this tells me the list to sales price ratio in Sunnyvale will follow. It was already back to almost 100%. We will be above 100% by the end of February, meaning people will be paying premier prices in Sunnyvale once again, 5, 6, 7, 8% over asking price. Why is that important? When buyers go to Sunnyvale first and get priced out, they move into other markets. One of the markets they move into is Milpitas. You can see the 237 corridor. If you get priced out of Sunnyvale, you move to Milpitas to look. Look at what happened in Milpitas. Look at that absorption rate. In the last 3 or 4 weeks, Sunnyvale's already popped 100, 200K over asking price, and immediately the buyers moved to Milpitas, right? So this is something we dig deep in with you. We have a one-on-one with you. If you tell us, I want to buy in Sunnyvale, we'll share these numbers with you. We'll share with you the timelines based on your budget and try to create a strategy to understand the valuations, understand the movements in the market, and he'll still help you achieve whatever it is that you'd like to achieve as a buyer or seller. So any market you're looking at, we can do something like I just showed you. If you're looking in Willow Glen as a buyer or seller, we'll distill this information into your market. We won't look at the nation, we won't look at Santa Clara County, we'll look at your price point in your area. If you're a buyer looking into a specific market, we'll show you the same things. We'll strategize around timing, around numbers, your budget, your current interest rate, so that you don't miss opportunities. You don't, in a market that's appreciating, you don't chase that tail by, I'll try to go just under. The inverse is, if we start to see drops, we'll tell you, you can offer less. They don't know it yet, but we know it, and we'll show you that. Whenever we give you a valuation, it won't be like, how did they come up with that number? We will actually show you. We will show you our methodology. We'll show you the strategy behind the number we give you, and hopefully that'll help you make some incredibly, really good buying and selling decisions this year or whenever your timeline is. So that's all I have for tonight. If you have any questions, if you'd like a one-on-one with the person that invited you, and I'll come along to help explain this, we'd love to do it. Even if you're not yet ready to buy or sell, understanding this really puts you in a great position to when you are ready to buy or sell. We'll monitor the markets that you're interested in, whether it's your home for sale or that you want to buy into. We'll strategize around timing, valuations, and things like this. So you're always in a prime position to make really smart decisions. So with that, I'll thank you. I wish you a good night. FolloFollow up with the person that invited you. Have any questions? You want a meeting? We're happy to do it. And I hope everybody has a great evening. Thank you.